Hello, this is Big A with ETFtrendtrading.com, and this is a free teaching on why have risk controls. Basically, whether you buy my course or not, I do care whether you lose your whole portfolio or half your account in a mutual fund or trading Forex or options or even ETFs. Just in general, I want to help people to be able to not lose their money. And one of the ways I can teach that is on risk controls and proper position sizing. And this teaching, I'm going to actually give you the formula that I use for my advanced members in my course. So I can't share all the specifics of the technical system, but I absolutely can share this part. So the more severe the drawdown, the harder it is it becomes to undo the damage as shown in the numbers below. Okay, let's say you have a 10% drawdown. That's what's on the left here is the size of the drawdown. On the right is the size you need to make it up. Many amateurs will think if they lost 40%, then they only need to make 40% to get it back. Well, that's not true because you have a new lower starting balance. You actually need to make almost 67% in order to make it back. And at the far end of the spectrum, if you have an 80% loss, you need to make 400% gain. That, my friend, is why you've got to keep your drawdowns minimal. Small drawdowns equals easy recovery. This 11.1%, this can be made up in one good trend used in my ETF trading system. If you happen to have 20 losers in a row at a 1% risk each time, which would be extremely, very unlikely. Even 10 losers in a row is extremely unlikely. 25%. That can be made up in a short period of time, a couple of decent trends. So that is why professional money managers only risk 1 or 2% per trade. It's because no matter how good your trading system is, at some point statistically you will have 10 losers in a row. Even the guys that have the systems that are 90% winning systems, which I don't like because they're upside down on their risk-reward ratios. Now many of my competitors here who give you a lot of hype and say, you can trade up to 5% of your account and use extremely high leverage. They're not looking out for your good, or they're just ignorant because they don't have real trading experience. You cannot risk 5 or 10% of your account on each trade. So one of the things that they also say is place your stop at say $110.10. because that's where a major support or resistance is, or a trend line or a moving average or something along those lines. So they want to say just use a technical stop, and whatever it comes out to on risk percentage is whatever it comes out to. So some trades you could risk 3%, some trades you could use risk 6%. That's wrong, it's bad, it's going to lose you money. First of all, because it's a different risk percentage on each first trade, but more importantly is that it's too high of risk. And it's not based off of position sizing. It's just based off of a technical stop. Now other, I'll call them false teachers, they reverse this and they say, hey, only risk 2% total and let that determine your stop. So it might be right in the middle of a support or resistance or not at the best technical spot. This is also wrong, and it will hurt you because it's important to have the correct technical stop. So the answer is to do both. That's what I do, that's what I teach, that's what my students do. You use a percentage stop of total equity and you use a technical stop together. So that's very simple to do. If you had a 2% risk on your trade and you had to go to, say, that same stop example used of $100.10, that was a good technical area say that was on the other side of major support resistance, or in my case, I don't even have to use trend lines or most indicators, but not on the technical side. If that was your good stop, then, and that happened to be 3% on the number of shares, you just lower the number of shares you're going to trade. It's very simple. You just lower it. That is the answer to money management and position sizing, and using a small amount, doing what the pros do, and that's risking only 1 or 2% per trade total. So this is so important. I can't stress it enough. You need to use a percentage stop, total equity, and your technical stop together at the same time. Even if you don't buy my system, that tip alone, if you switch that on your existing system, will help you tremendously. Okay, the system of entries, stops, and profit taking is only half of your key to success. The other half is money management. If you get this part wrong, you will lose your account every time, regardless of how good your system is. And most of the other systems out there aren't that good, so that other half is very important to have a good trading system. Like Warren Buffett says, there's only 2 rules in investing. Rule number 1, don't lose your money. And rule number 2, don't forget rule number 1. I'd like to add a third rule, and that is that correct money management and position sizing must be mastered to ensure your long-term success. It's got to be mastered. This is just as important as the actual system itself, the technical system. So more risk does not always equal more reward. Sometimes more risk just equals more risk. So if you want to be here for the long term, the long haul, and be able to be trading your 401k or IRA for the next 10 or 20 years, you've got to remember only 1 to 2% max risk on each trade total, and you want to use a technical and a percentage stop together at the same time. Now, the percentage stop is easy. Use 1 or 2% max risk. The technical stop, you'll need the system for that. So feel free to read my other articles or see my other videos at etftrendtrading.com. Thank you.